So think of a word like a really common word that you probably use in your everyday life without a second thought.
Okay.
Just a single, totally harmless sounding word that describes, packing a few things together to save time or save some money.
Yeah, it sounds like I don't know, a sales tactic or maybe a cable TV package.
Exactly. But what if I told you this exact word routinely trips up some of the most sophisticated, well-run enterprises in the United States? Like it triggers billions of dollars in fines, massive lawsuits, and just these sprawling regulatory nightmares. And that word is bundling.
Yeah, it's wild because inside the walls of a major corporation, it is an absolute minefield. It's something that creates liabilities across multiple departments, like all at the exact same time.
And navigating that minefield is exactly what we're doing for you on today's deep dive.
Mm.
We're exploring a really comprehensive new report published today, actually July 23, 2026.
Fresh off the press.
Right, by the enterprise AI transformation firm, the Agentics. So they've mapped out this massive corporate blind spot that they call the bundling problem.
Which is such a fitting name.
It really is. So our mission today is to examine their entire analysis end to end. We'll look at how one physical commercial act triggers four entirely unrelated bodies of law and why traditional corporate compliance models just constantly fail to catch it.
Yeah, they really do fail.
And then we'll get into how a new agentic AI layer inside a company's core software is shifting the whole paradigm, like going from merely detecting mistakes to actually preventing them entirely.
Which is a huge leap.
Huge. So, okay, let's unpack this.
Yeah.
Because when you read through the Agentics findings, you quickly realize this isn't just about dry corporate compliance. I mean, it's really an exploration of how complex systems break down under their own weight and, how artificial intelligence is being deployed to stitch them back together.
Well, I mean, the foundational premise of this report is really a matter of definition. Bundling isn't just one single problem.
Right.
It is four different legal problems wearing the exact same word, and it's spread across 9 different industry verticals.
Wow.
Yeah, so the physical act is identical everywhere, right? A company is selling or maybe filing things together. But the legal reality of that act changes entirely depending on which department or which regulatory agency happens to be looking at it.
I found myself thinking of it like a chameleon. It's like this one concept that completely changes its legal colors depending on the environment it's in.
That's a great way to put it.
But looking at the scope of this report, claiming this one word triggers four entirely different legal realities. I mean, I can maybe guess the antitrust implications of bundling products, but how does it spread so wide?
So we can break down those 4 distinct legal universes to see just how disjointed this actually gets. Let's start with the first regime, which you just mentioned, right?
Right.
Antitrust.
Yeah.
In the antitrust universe, bundling is fundamentally a pricing and market power question. The regulators there are looking for harm in the form of coercion. So, forcing a customer to take something they don't want or the exclusion of a competitor.
Right, like using your weight in one market to basically crush a smaller rival in another.
Precisely. But then you walk down the hall to the revenue cycle department and you enter the second regime, which is healthcare billing.
Okay.
And here, bundling has absolutely nothing to do with market power. It is strictly a coding accuracy question. And the massive irony here is that in healthcare, the actual crime is usually unbundling.
Wait, really? Unbundling is the crime.
Yeah. The system actually expects certain procedures to be built together as a single bundle. So if you split them apart to charge for each tiny little component, you artificially inflate your reimbursement.
Oh, wow. So in one department, bundling gets you investigated, and in another department, failing to bundle gets you investigated.
Yeah, the contradiction is just staggering. And then we move to the third regime, campaign finance.
Okay, that's a pivot.
Completely different universe.
Yeah.
In this one, bundling is purely a disclosure question. So when lobbyists gather individual political contributions from various donors and, hand them over together, they are bundling.
Right, I've heard that term in politics.
Exactly. And unlike antitrust, which is very subjective, this regime has a hard, bright-line mathematical threshold. For this current calendar year, 2026, that threshold is exactly $24,000.
24,000, okay.
Yeah, you hit that exact number, and you are legally required to file specific disclosures with the Federal Election Commission.
Got it. And the fourth regime involves the FDA, which I assume has something to do with how medical products are submitted for approval.
Yep, that's the fourth legal universe, FDA submissions. When medical device manufacturers talk about bundling, they mean packaging multiple devices or multiple clinical indications into a single pre-market submission.
Okay, and why does that matter?
because doing that directly impacts the user fees the company has to pay, and it fundamentally alters the FDA's statutory review clock.
I mean, this paints a frankly terrifying picture for a chief compliance officer.
Oh, absolute nightmare.
Right, because you have the pricing team running a portfolio discount, the billing team coding a medical procedure, the government affairs team tracking political contributions, and their regulatory team packaging a device filing.
Yep, all in the same building.
And they are all using the word bundling, like they think they're talking about the same thing. But as the Agentics point out, none of them are operating under the same rules. So if the definitions are this fractured, how do large organizations even keep track of the liability?
The harsh reality, at least according to the report, is that they largely don't.
Oh.
Yeah, and that brings us to this structural trap of modern corporate governance, because the current management approach is the very reason the system is failing. The Agentics identify this as what they call the diffuse ownership problem.
Meaning too many cooks in the kitchen.
Basically, if you trace the life cycle of a typical commercial bundle in a large enterprise, it just touches too many hands. Like, sales designs the bundle to win a client. Then finance steps in to run the margin analysis and set the price. Then operations is responsible for actually delivering or provisioning the bundle. The accounting or revenue cycle team sends out the bill. And then legal might, glance at the master service agreement at some point.
So there are 5 different sets of hands on the steering wheel, but nobody's actually looking at the whole road. Like, sales doesn't know the coding rules, and legal never sees the granular pricing data.
Exactly. And because no single function has visibility across that entire chain, literally no one is truly accountable for the legality of the end-to-end process.
That sounds like a disaster waiting to happen.
And it is. The stakes here aren't just theoretical. The report highlights the False Claims Act enforcement data, and recoveries hit a record $6.8 billion in fiscal year 2025.
Wait, 6.8 billion?
Billion, with a B. A massive portion of that was driven by healthcare, and specifically by whistleblowers. These are legally known as qui tam cases.
Right, where a private citizen sues on behalf of the government. Right.
Exactly, and they take a percentage of the recovery. Whistleblowers accounted for roughly $5.3 billion of that total.
Which, I mean, that makes perfect sense when you think about that diffuse ownership problem, because those whistleblowers aren't usually outside observers.
No, they're insiders.
Yeah, they're often a pricing analyst or a medical coder who just sees these disconnected systems failing. They raise a flag, they get completely ignored by the siloed departments who only care about their specific metric, and eventually, out of just pure frustration, they take that data to the government.
That is the exact mechanism of failure. And the Agentics emphasize that the most critical flaw driving all of this is the way companies currently build their compliance controls. Today, controls are almost entirely detective rather than preventative.
Meaning, they're designed to find the fire after the house is already burned down?
Precisely. The control always fires after the legal commitment is already made.
Right.
Like, a bundled pricing deal only goes to the legal department for review after the contract is structured and verbally agreed upon with the clients.
Too late.
Exactly. A bundled political contribution is only aggregated and checked by a compliance officer at the end of the reporting quarter. A medical claim is scrubbed for unbundled codes long after the clinical work is actually finished. The liability has already materialized by the time the company even starts looking for it.
See, I'm struggling to picture why this hasn't been solved by standard software yet.
It's a common question.
I mean, we live in an era of massive enterprise data, right? Companies run these incredibly sophisticated software systems that track literally every penny. Why can't an organization just sit down, write a master bundling policy, hard code it into their central software, and just be done with it? Like, write a rule that says, if X happens, block Y, and push it out to the whole company.
Well, what's fascinating here is that the report systematically proves why a uniform, hard-coded policy is literally impossible.
Really impossible.
Because the underlying rules of these different regimes are fundamentally asymmetrical.
Okay, how so?
Well, some rules operate on rigid, shifting math, while others rely entirely on subjective, fact-intensive human judgment. If you try to write a one-size-fits-all software policy, it will break the second it touches actual daily operations. To really understand why, we have to look closely at the contrast between healthcare and antitrust.
Let's do that. Because earlier you mentioned that healthcare actually requires bundling, which seems totally inverted from how antitrust works.
Yeah, and the eugenics call this the inverted risk. So in healthcare billing, the system demands comprehensive codes. Splitting up procedures that should be built together inflates your reimbursement, and doing that intentionally violates the False Claims Act.
Right.
The Centers for Medicare and Medicaid Services, CMS, they govern this using a system called NCCI edits. That's the National Correct Coding Initiative.
Okay.
These are these massive, complex tables of procedure codes that absolutely cannot be built together on the same patient on the same day. But the complication is that these tables aren't static. CMS updates them every single quarter.
Oh, I see. So if a company's IT department hard codes a bypass rule into the billing software in January, that rule could be silently generating false claims by April because the government just changed the underlying table.
Exactly. And the complexity goes even deeper than that, because the rules do acknowledge that sometimes a doctor does perform two procedures that are normally bundled, but under genuinely separate circumstances.
Okay, so there are exceptions.
Right. You're allowed to bypass the NCCI edit using something called modifier 59. It basically acts as a flag telling the system, I know these usually bundle, but this was a distinct procedural service.
And the report is very explicit about this. Modifier 59 isn't just a magic override button, right? You can't just have your billing software automatically slap it on a claim every time it hits an error just to get the invoice paid.
Oh, absolutely not. If a company configures its software to do that, they are creating a massive liability. Applying that modifier requires actual independent clinical documentation proving that the service was performed on a different anatomic site or during a different patient encounter on the same day.
It's highly contextual.
Exactly. If you apply the modifier automatically just to clear an IT bottleneck without the underlying medical record supporting it, you've just converted a simple administrative coding error into a deliberate false claim against the federal government. That requires real-time clinical context, not just a rigid, hard-coded software rule.
Wow. So that's the rigid, constantly shifting, highly contextual math of healthcare. But antitrust is a totally different landscape.
Completely different.
Because if I'm a pricing director, how do I even know if my bundle is illegal? In antitrust, the harm is usually defined as coercion. But coercion sounds like a concept from a mob movie, not a B2B software deal. What do regulators actually consider harmful?
Yeah, so antitrust rules are the exact opposite of healthcare's fixed tables. They are these fact-intensive judicial standards born out of decades of case law. Regulators look at whether a company has significant market power and is using a bundle to either force a buyer's hand or starve a rival of oxygen. And the courts have outlined three distinct theories of harm for this. First is pieing, which is largely governed by a landmark Supreme Court case called Jefferson Parish. This occurs when a seller uses their dominance in one product to force you to buy a completely different product you don't necessarily want. The harm there is the coercion of the buyer.
So, like telling a hospital they can only buy your life-saving surgical robot if they also sign an exclusive contract for your basic surgical gloves.
Exactly that. The second theory is bundled discounts. This is when a seller offers a massive discount, but conditions it on the buyer taking a whole portfolio of products. This might completely exclude a smaller rival who only manufactures one of those products and simply cannot afford to match the massive overall discount.
Makes sense.
And the third theory is predatory pricing, stemming from the Brook Group case. This is where a company prices a bundle below their actual cost of production for the sole purpose of bankrupting competitors.
With the plan to just jack up prices again once the rivals are dead.
You got it.
You know, there is a very specific warning in the Agentics report regarding antitrust compliance, specifically about how companies try to measure their own market power. They point out this huge trap companies fall into regarding market share and concentration metrics.
Yeah, this raises an incredibly important point. The report warns against treating metrics like market share or the HHI as legal pass-fail rules.
HHI being the Herfindahl-Hirschman index, right?
Yes, exactly. It's a standard economic formula used to measure market concentration. A lot of corporate compliance programs will look at an HHI score or look at a market share number, say 30%, and program a rule that says, okay, if our market share is below 30%, our bundles are safe. If it's above 30%, flag it for legal.
But the regulators don't view 30% as a magic shield.
They absolutely do not. The Agentics clarify that those numbers are just screening benchmarks used by the government to decide where to look first. They are not the law itself. Treating them like hard-coded rules gives business teams a false sense of confidence right at the exact moment when nuanced human judgment is actually needed most.
But this brings up a conflict, though. If antitrust law is based on these highly subjective judicial standards, and we can't just use market share as a simple math equation, how can any software system possibly help a company catch these issues before they happen?
Well, the nuance is that while you can't compute coercion, you can compute the mathematical mechanics of exclusion, specifically for bundled discounts. And this relies on a very specific legal standard from the Ninth Circuit Court of Appeals called the Peace Health Test.
Let me actually break down the math of the Peace Health test for you listening, because it is a brilliant piece of logic.
It really is.
So the test aims to figure out if your bundled discount is illegally squeezing out a competitor. To do it, you have to take the entire dollar amount of the discount you're offering across the whole bundle and allocate all of that discount to just the single product where you face competition.
Right.
And if applying that massive combined discount makes your price for that specific product drop below your actual cost to produce it, then a smaller, equally efficient rival couldn't possibly match your price without going bankrupt. Therefore, your bundle is likely exclusionary and illegal.
Exactly. It basically forces a very specific mathematical logic onto a subjective problem.
But here's what strikes me. If I'm understanding this correctly, all the data required to run that Peace Health test, like the list prices, the manufacturing costs, the proposed discount percentages, all of that data exists in the company's internal systems before the contract is ever signed.
It's all there.
But traditionally, that math only gets calculated by a team of expensive antitrust lawyers months or years later during discovery, after a competitor has already filed a lawsuit against you.
Yeah, the current workflow is entirely backward. And that realization is really the pivot point of the Agentic's proposed solution. Because if the data to run the Peace Health test, or check an NCCI edit, or aggregate a campaign contribution is already sitting in the company's systems before the ink is even dry, we need an architecture that acts on it at that exact moment.
We need to shift from detective controls to preventative ones.
Exactly.
And this is where we dive into the core technological solution of the deep dive. The Agentics propose building what they call a governed agentic layer that sits inside or directly alongside a company's ERP. And for anyone not deeply entrenched in enterprise software, the ERP is the enterprise resource planning system. It's like the central nervous system of a major corporation. It handles the accounting, the supply chain, the procurement, the invoicing. So why is the ERP the specific intervention point here?
Because the ERP is the bottleneck where reality happens. It's the very last place where fixing a mistake is still relatively cheap, and it's the very first place where all the scattered evidence, the pricing agreements, the supplier contracts, the medical billing codes, where all finally converges into one unified database.
Right.
Because once a sales order officially posts in the ERP, it becomes a legally binding commitment. Once a medical claim leaves the ERP, it becomes a formal representation to the federal government. So you have to intercept the transaction right at that threshold.
Now, the report outlines this continuous 5-step agentic loop for how this AI layer actually operates within the ERP.
Yeah.
But I'm curious, how does it function without just freezing the whole company? Because it sounds like a lot of processing.
Well, it's designed to be completely frictionless until it detects an anomaly. So first, the AI agent watches the transaction stream in real time. Second, when it spots a bundle, it decomposes it into its individual parts. Third, it tests those parts against the live external rules. So like pinging today's updated CMS tables, or running that Peace Health discount math we just discussed, or checking the current FEC threshold.
Right, the $24,000 limit.
Exactly.
Huh?
Fourth, based on the test, it either blocks the transaction entirely or routes it to a designated human expert. And fifth, it logs the entire decision-making process immutably for future audit purposes.
It makes me think of a nightclub bouncer. Like, the way compliance works right now is like a nightclub hiring a detective to track down underage patrons the morning after the party is already over.
Yes.
Right. The underage kids drank, the damage is done, and the fines are inevitably coming. But what this agentic layer does is put a highly capable bouncer right at the front door. The bouncer checks the ID, cross-references it with the guest list, and just stops the underage person from ever crossing the threshold into the club.
It's a perfect analogy. The bouncer stops the liability before it enters the ecosystem.
I do have to push back on one major aspect of this, though. Given everything we've just discussed about how nuanced and subjective these laws are, isn't it incredibly dangerous to let an AI make complex legal decisions? Like, if a Supreme Court precedent dictates antitrust compliance, how on earth can an AI agent decide if a bundle is lawful?
It absolutely cannot.
Okay.
And that brings up what is arguably the most critical governance warning in the entire report, which they title the hard boundary. The Agentics forcefully outline that AI agents must never be allowed to make legal judgments,
Never.
under no circumstances.
Yeah.
I mean, an AI agent is phenomenal at computing the attribution math for a discount. It is flawless at checking a pair of billing codes against a massive database. It's perfect for aggregating campaign contributions to see if they hit exactly $24,000.
Right. The math part.
Exactly.
Yeah.
But it must never be allowed to conclude on its own that a bundle is lawful. It was never attempt to determine if a company possesses market power. And it was never automatically apply a critical modifier like 59 just to force a claim through the system.
Because if you let the AI do that, you are basically actively manufacturing a weapon against yourself for future litigation.
Oh, the liability becomes infinitely worse. If an AI oversteps and makes a legal determination, it generates a permanent, highly discoverable digital record of an unqualified legal conclusion.
Oof.
Imagine regulators subpoenaing your systems and finding an AI blindly certifying hundreds of transactions as legal without any human oversight or clinical documentation.
That would be a disaster.
Total disaster. The agent's job is not make the final call. The agent's job is to freeze the transaction at the ERP level, gather all the scattered pricing data, pull the clinical documents, organize the historical context, and then put a qualified human like a lawyer, a certified medical coder, or a compliance officer in front of the full evidentiary picture.
See, here is where it gets really interesting for you listening. Because the true value of this AI layer isn't in replacing the human decision maker. The value is in perfectly teeing up the human to make the right decision, without that human having to spend 3 hours digging through 4 different software silos just to understand the context of one single transaction.
Exactly. The judgment remains entirely with the human expert. The AI simply removes the possibility of the transaction slipping through the cracks unexamined.
So if a company leader is listening to this deep dive right now and realizing their organization is completely exposed to the bundling problem, where do they even begin? Because trying to simultaneously overhaul antitrust, healthcare billing, and campaign finance compliance all at once sounds like an impossible corporate mandate.
Yeah, and the report is very pragmatic about this. It strongly advises against a massive simultaneous overhaul. You start small, you pick one regulatory regime and one specific workflow, just one. Typically, that means starting with healthcare coding or bundled pricing discounts, because that is where the financial exposure is usually the highest and the rules are the most mathematically codifiable. So you map out exactly how a bundle travels from the initial design phase to a finalized legal act in the ERP, and you wire the AI agent into that specific stream.
And there is a specific deployment strategy they recommend before ever letting the AI actually block a transaction. They call it shadow mode.
Oh, shadow mode is a brilliant strategy for navigating internal corporate politics and improving return on investment. Basically, you deploy the agent into the ERP, but you run it in observe-only mode for one full reporting cycle.
So it doesn't interrupt anything.
Right, it doesn't block anything at all. It just watches the data flow and takes notes. And at the end of the month, the AI generates a quantified, evidence-backed report. It essentially tells management, here is exactly how much non-compliant activity slipped through our current human controls this month.
You essentially get a hard dollar figure attached to your organization's blind spots. Like, you aren't guessing about liability anymore. You have a literal receipt.
Exactly. And that undeniable data is what builds the business case to management. Once you've proven the exact value of the missed errors in shadow mode, you can confidently turn on the blocking features and begin actually routing the anomalies to your human experts for intervention.
Okay, let's pull all of this together. What the Agentics have illustrated in this report is that complex corporate compliance isn't a problem you can solve by just training employees harder or, yelling at the sales team to read the manual more closely.
No, it doesn't work.
It is fundamentally a systems problem.
Yeah.
The rules are asymmetrical, the data required to check those rules is scattered across different software silos, and the ownership of the whole process is entirely diffuse. But by moving an agentic AI layer directly into the ERP right at the point of transaction, companies can shift their entire posture. Like, they stop catching incredibly expensive mistakes after the fact and they start preventing them entirely.
And if we connect this to the bigger picture, for you, the listener, just think about the industry you work in, whether it's finance, manufacturing, or tech. you almost certainly deal with detective controls.
Oh, definitely.
Right. You deal with end-of-month reconciliations or retrospective audits or quality checks that happen entirely too late in the process. The Agentics framework of moving the intelligence directly to the point of transaction is a highly adaptable mental model. It's really about empowering the human expert with perfect context exactly when it matters most, shifting from reaction to prevention.
It changes the operational game completely,
Yeah.
but it also leaves me with a final, slightly unnerving thought to mull over, and I want you to explore this too. If agentic AI eventually becomes the gold standard for perfectly enforcing compliance inside a company's systems, catching every anomaly, every miscoded bill, every exclusionary discount right before it happens, how long will it be before government regulators mandate that these AI systems report those exact anomalies directly to them in real time? Right. Are we looking at a future where the enterprise software itself effectively automates the whistleblower process? Definitely something to think about. Until next time, keep digging deeper.